On February 2, 2026, SpaceX acquired xAI, Elon Musk's AI company, in the largest private merger in human history. Combined valuation, $1.25 trillion. They've since filed for an IPO targeting $1.75 trillion. If it lists at that number, it becomes the sixth most valuable company on Earth, raising $75 billion, more than double the previous record set by Saudi Aramco in 2019. You cannot buy SpaceX today. It's private, but there are specific ways to position before the IPO, and more importantly, there's an infrastructure play beneath this story that wins regardless of whether the space thesis is right. That's what this video covers. Not financial advice, this is an analysis. The merger rationale is orbital data centers. Musk's stated claim, within 2 to 3 years, the lowest cost way to generate AI compute will be in space. Here's why that's actually defensible. Two costs dominate ground-based AI compute: electricity and cooling. Major data centers spend 30 to 40% of their energy budget just on cooling chips. In orbit, passive heat radiation into near-zero vacuum, free, and solar power at certain altitudes runs 24 hours, no grid dependency. The counter-argument: launching mass is still expensive. Heat dissipation at high chip density and vacuum is an unsolved engineering problem, and latency from orbit adds milliseconds to every inference call. StarCloud, 1 GPU in orbit, is a proof of concept. A cost-competitive orbital compute platform has never been built. Musk's 2 to 3 year timeline is aggressive. The direction is probably right, the timeline is probably wrong. This is a 5 to 10 year thesis being sold as a 3-year story. That gap matters for how you size this position. SpaceX filed its confidential S-1 in late March 2026. Target: 1.75T valuation, 75B raise, June 2026 NASDAQ listing. Goldman JPMorgan, Morgan Stanley, BofA, Citi. The full institutional underwriting stack. The underlying business justifies serious attention. SpaceX, 2025, 16B revenue. We done 8 by B profit. Starlink hit 17 million subscribers with 2026 revenue projected above 22 by. This is a profitable, fast-growing company, not a vision play propped up by narrative. But at $1.75 trillion, you're at roughly 80x 2025 revenue. The multiple prices in orbital compute delivery. You're buying the vision, not just the business. And Musk controls SpaceX through a voting structure that gives public shareholders no meaningful recourse. You are buying exposure to his execution, not a seat at the table. SpaceX is private. 4 ways to position today. DXYZ, Destiny Tech 100, publicly traded on NASDAQ, holds SpaceX private shares as one of its largest positions, trades at a premium to NAVI because pre-IPO SpaceX exposure is scarce. You're paying extra for access. Know that going in. XOVR, Destiny Venture ETF, Jocker 10% SpaceX allocation. ETF wrapper, slightly less premium than DXYZ. ARKVX, ARK Venture Fund, holds private SpaceX shares, accessible through select brokers. Space sector ETFs. ARKX, UFO, NASA. Diversified exposure. No direct SpaceX shares, but broad participation in the sector. Lower premium, lower concentration risk. One number worth anchoring to. $45 billion was invested in the space sector in 2025 alone. The build-out is real and ongoing, regardless of how the IPO trades. Here's where it gets more interesting. The space AI story needs chips. Custom silicon designed for orbital constraints, low power, high reliability, radiation hardened. That demand flows into an existing supply chain, and 3 publicly traded companies sit at the center of it regardless of whether SpaceX's orbital compute thesis plays out on schedule. Broadcom, AVGO. In 2026, Anthropic signed a $21 billion deal with Broadcom for custom AI chips, XPUs, at roughly 60% of the cost of NVIDIA's Blackwell GPUs for specific workloads. OpenAI followed with a $10 billion deal. Hyperscalers are buying these to escape the NVIDIA pricing premium. Orbital compute nodes will need custom silicon, not commodity GPUs. Broadcom is the dominant player in custom chip design. This isn't speculative. The contracts are signed and growing. TSMC makes the chips. All of them. NVIDIA's GPUs, Broadcom's XPUs, Apple's processors, AMD, all manufactured by TSMC. NVIDIA's Space One chip, built specifically for orbital AI applications, will be fabricated by TSMC. 2025 financials: $122.4 billion revenue, 35.9% growth, 51% operating margin. That margin figure is the tell. This is a profitable near monopoly, not a growth company burning cash. TSMC trades at 22x forward earnings. For a business with 51% margins and 90% market share in advanced logic, that's not expensive. In a world where every AI company is designing custom silicon, which is clearly the direction, TSMC wins regardless of who wins the AI race. They make everyone's chips. Lam Research. LRCX one step further back. Lam makes the equipment foundries like TSMC need to build chips, etching systems, deposition tools, cleaning equipment. Every new fab TSMC opens requires Lam's machinery. Q4 2025 revenue: $5.34 billion, up from $4.37 billion the quarter prior. Growing fast on a large base. Overlooked because it's 2 steps removed from AI headlines, which is exactly why it may be undervalued relative to its strategic position. The railroad analogy: if TSMC is the track, Lam builds the equipment that lays it. 2 distinct bets here, be clear which one you're making. The SpaceX bet, via DXYZ, XOVR, or ARKV, requires orbital compute to become cost competitive, roughly on Musk's timeline. High conviction required, high concentration risk. If the timeline slips by 5 years, you're holding a premium position through a long wait. The infrastructure bet, TSMC, Broadcom, Lam Research, requires only that AI chip demand keeps growing and custom silicon keeps displacing commodity GPUs. Both of those are observable trends today, not predictions. Lower conviction required, more durable thesis. These aren't mutually exclusive. Many investors will hold a small, speculative SpaceX exposure position alongside larger infrastructure positions. Size accordingly. 4 risks worth naming directly. Orbital compute may not scale on this timeline. 1 GPU in orbit is not a data center. Heat dissipation at commercial chip density and vacuum is an unsolved problem. This could take a decade longer than projected. Regulatory exposure. A $1.75t entity controlling satellite internet, AI infrastructure, and a major social platform will attract SEC, DOJ, FCC, and FTC scrutiny. Antitrust review could delay the IPO or impose structural changes. xAI's burn rate. xAI is scaling infrastructure aggressively and burning cash. SpaceX's profitability currently covers it. That integration risk is real and costs are growing. Valuation math. At $1.75t, almost any reasonable DCF requires orbital compute delivering. If the thesis is right but takes 10 years instead of 3, the discount rate rebuilds the model entirely. These don't invalidate the thesis. They define how much of your portfolio this should represent. The SpaceX S1 ETF fact sheets for DXYZ, ARKX, UFO, and NASA, and the financials for TSMC, Broadcom, and Lam Research are all linked in the description. The IPO will be a market-moving event regardless of where you end up. Understanding the thesis now: orbital compute, Pomerio, custom, silicon, the infrastructure layer beneath all of it, puts you in a position to make that decision with real information instead of reacting to headlines. Subscribe for more AI investment analysis with the actual numbers behind it. See you in the next one. By not bonsi sobre dan sen dan svand. Disclaimer: nothing in this video is financial or investment advice. Educational purposes only. Do your own research. Consult a qualified financial professional before making investment decisions.